I want you to think about the last time you felt genuinely good about your finances. Maybe you got a raise. Maybe you paid off a debt. Maybe you just checked your account and it wasn't as bad as you expected, which honestly, in this economy, counts as a win. Now I want you to think about something else. While you were feeling good about that raise, that 4%, maybe 5% bump your employer handed you like a participation trophy somewhere on the other side of the equation, something very different was happening. And I don't mean that dramatically. I mean it mathematically, quietly, in a way that most people will never notice until it's too late. Because right now, in real time, there is a wealth transfer happening, not through some shadowy conspiracy, not through anything illegal, but through a combination of financial mechanics, behavioral psychology, and systems most people were never taught to understand. And the people on the wrong side of it aren't lazy, they aren't stupid, they're just playing a game nobody fully explained to them. So today, I want to show you exactly how this transfer works, who's on each side of it, and most importantly, what the people quietly building wealth are doing differently. Let's start with inflation. And I know you've heard about inflation. You've felt it at the grocery store. You've winced at a gas station. You've done the mental gymnastics of justifying a $17 cocktail at a bar that definitely used to charge $9. But here's the part of inflation that doesn't make it into the conversation. Inflation isn't just a tax on your spending, it's a tax on your savings. Because every dollar sitting in a traditional savings account earning 0.5% interest, which, by the way, is still what most big banks are offering, is quietly losing purchasing power every single year. If inflation runs at 3% and your savings account returns 0.5%, you're not breaking even. You're losing 2.5% annually in real terms, on money you think is sitting there safely. Over 10 years, that's not a rounding error. That's a meaningful, compounding destruction of purchasing power happening silently in the background while you go about your life. And here's where the transfer happens. Because that purchasing power doesn't just disappear, it shifts. It moves from people holding cash and low-yield savings to the people who own assets, real estate, stocks, businesses, things whose value rises with inflation rather than getting eroded by it. This is the oldest wealth mechanic in modern finance. Asset owners get richer during inflationary periods. Cash holders get poorer. And the cruel irony is that the people with the least financial education, the people who were never taught to invest, never taught to think about assets, are disproportionately the ones holding cash. Now let's talk about debt, because debt is the second engine of this transfer, and it works in a way that is simultaneously obvious and completely misunderstood. There are two kinds of debt, and almost nobody frames it this way, but bear with me. There's debt that makes you poorer, credit card balances, car loans on depreciating vehicles, buy now, pay later schemes that turn a $200 purchase into a $280 purchase because the math was buried in the fine print. This debt is a wealth extraction machine. You pay interest, the lender collects it, your net worth goes down, theirs goes up, and then there's debt that makes other people poorer. And this is the part that's almost never discussed in personal finance content because it's uncomfortable. Because the mortgage you're paying on your home every month, that's also someone else's wealth building vehicle. Let me be specific. If you rent an apartment for $1,800 a month, you are paying your landlord's mortgage. You are covering their property taxes. You are funding their maintenance costs. And when their asset appreciates, which over any meaningful time horizon, real estate generally does, you get none of it. You get a place to live. They get equity. This is not an argument that renting is stupid. Renting makes complete sense in hundreds of situations. Flexibility, high-cost markets, short-term living. But it is an argument that the financial relationship between asset owners and non-asset owners is not neutral. It is directional. And understanding which direction it flows is the first step to changing which side you're on. The third engine is one that almost nobody talks about because it's invisible until you know where to look. And that's the fee economy. Because here's a number that will make your eye twitch. The average actively managed mutual fund charges somewhere between 0.5% and 1.5% in annual fees. Some charge more. And if you're sitting there thinking, okay, 1%, that's barely anything, I want to walk you through what that actually means over time. Let's say you invest $10,000. You earn 7% per year on average. Over 30 years with no fees, that $10,000 grows to roughly $76,000. A 1% annual fee sounds small, right? But over the same 30 years, that same investment with a 1% fee grows to only about $57,000. A 1% fee just cost you $19,000 on a single $10,000 investment. Now multiply that across your entire retirement portfolio, across decades of contributions. The number stops being abstract really quickly. And the money you lost to fees, it didn't evaporate. It went to the fund manager, who, by the way, in most cases underperformed a basic index fund anyway. This is the fee economy. It is legal. It is normalized. It is baked into the products most people are sold by the financial services industry, and it quietly transfers hundreds of thousands of dollars from the average investor to institutions over the course of a lifetime. The response to this isn't complicated, by the way. Low-cost index funds have existed for decades. Vanguard, Fidelity, Schwab. You can own broadly diversified funds for 0.03% to 0.05% in fees. That's not a typo. 0.03% versus 1.5%. The math difference over 30 years is staggering. And yet the financial services industry has done a masterful job job of convincing people that complexity equals value, that a fund manager who charges more must be doing more, that active management justifies its cost. The data says otherwise, consistently, year after year. The majority of actively managed funds underperform their benchmark index over any 10-year period. You are paying more for worse results. And the industry depends on you not fully understanding that. So here's where we land. Inflation transfers wealth from cash holders to asset owners. The debt economy transfers wealth from renters and borrowers to lenders and property owners. And the fee economy transfers wealth from individual investors to financial institutions. None of this requires a villain. None of this requires fraud or manipulation. It is just the mechanical outcome of systems most people were never taught to understand. And here's the part that should genuinely make you angry. These are not secrets. This information exists. It is freely available. The math on fee compounding is not hidden. The concept of inflation eroding purchasing power is in every economics textbook. But financial literacy is not taught in schools. It is not in the curriculum. And the financial services industry, which profits enormously from the gap between what people know and what they need to know, is not exactly rushing to close it. The people quietly building wealth right now are not smarter than you. They are not luckier than you. They just understand the mechanics of these systems and have positioned themselves accordingly. They own assets. They minimize fees. They use debt as a tool rather than a trap. And they started early, even when the amounts felt embarrassingly small. Because here's the uncomfortable truth about wealth. It does not reward intensity. It rewards consistency. The person who invests $200 a month for 30 years will almost always end up in a better position than the person who tries to time a market, pick winners, and chase the next opportunity. The transfer is happening whether you participate or not. The only question is which side of it you end up on. And the first step to being on the right side, understanding what's actually going on, which now you do. So drop your biggest financial question in the comments. The thing you've always wondered but felt embarrassed to ask. Because I promise you, if you're wondering it, 10,000 other people are too. And that's exactly the kind of video I want to make next.